Before Hurricane Milton even made landfall earlier this evening, the National Hurricane Center warned it would become one of the most destructive hurricanes on record.
The impacts of climate change are well known in terms of rising temperatures, extreme weather events, and melting ice caps. However, a less obvious yet profound consequence is unfolding in the global real estate market, from shifting insurance landscapes to new migration patterns. Climate change is creating waves in how and where people are buying homes. In this video, we explore how these unseen forces are reshaping property values and creating new dynamics in housing markets worldwide. As the planet warms and weather patterns grow increasingly unpredictable, an unprecedented phenomenon is taking place: climate migration. This refers to the movement of people from areas severely affected by climate change, whether due to rising sea levels, droughts, or increased wildfire risks, towards safer, more climate-resilient regions. What was once an abstract concern has now become a reality, with real estate markets beginning to feel the strain. Take Miami, for instance. Long a symbol of desirable coastal living, this city is now facing a future where sunny day flooding and hurricanes are regular events. These environmental risks are not just inconveniences. They are fundamentally altering property values. Homes in low-lying areas, once prized for their ocean views, are now depreciating as buyers and investors look elsewhere. In contrast, cities like Denver or Minneapolis, historically less glamorous markets, are seeing a surge in demand as they are perceived to be safer from the physical impacts of climate change. This trend reflects a broader pattern where populations are relocating from climate-vulnerable coastal areas to inland cities. It's no longer just about amenities or jobs, but about climate resilience, the ability of a region to withstand future environmental challenges. The increase in demand for homes in these safer areas has, predictably, driven prices up. Cities like Boise, Idaho, or Salt Lake City, Utah, which might have once been considered secondary markets, are now experiencing housing booms as they become refugees for climate migrants. The economic principle here is simple. As demand rises and supply remains static, prices inevitably follow. What we are witnessing is a real-time example of supply and demand economics, driven by an unexpected factor: climate. But the implications go beyond rising property prices. Entire communities are being reshaped as people flee from risk-prone areas, creating new housing pressures in previously underdeveloped markets. The second major factor transforming real estate markets is insurance. Or, more specifically, the growing difficulty of obtaining affordable insurance in high-risk areas. As climate risks become more pronounced, insurers are reassessing their coverage options, often with dramatic consequences. A home's insurability is increasingly becoming a key determinant of its market value. In Florida, for instance, where hurricane risk is ever present, insurance premiums have skyrocketed in the wake of more frequent storms. According to the National Flood Insurance Program, some homeowners in Miami and the Florida Keys are paying upwards of $10,000 annually for flood insurance. The impact on the housing market is immediate and profound. Properties in flood-prone areas are becoming more difficult to sell, not only because of the environmental risks, but because the costs of insuring them make ownership unsustainable for many. Moreover, in California, areas vulnerable to wildfires, such as Sonoma County, are seeing similar dynamics. As insurance companies either increase premiums or simply refuse to renew policies, homeowners find themselves in a bind. Unable to afford the necessary coverage, their properties lose value. This is a stark example of how climate risk is being priced into the market, where properties in high-risk areas become financial liabilities. Insurance companies are, by nature, risk-averse. As they retreat from climate-vulnerable areas, they leave homeowners with few options. This shift is driving what some are calling risk-adjusted real estate pricing, where a property's value is not determined solely by its location, size, or amenities, but also by its vulnerability to climate events and the affordability of protecting it. Conversely, homes in areas that are perceived as climate safe, places far from floodplains, fire zones, or coastal regions, are seeing an influx of interest as buyers seek both security and insurability. The importance of a home's ability to be insured at a reasonable cost cannot be understated. Without it, even the most desirable properties become unattractive to buyers and ultimately unsellable. As climate risks reshape residential markets, institutional investors and private equity firms are increasingly incorporating climate resilience into their real estate portfolios. This represents a significant shift in how investments in property are evaluated. No longer are investors merely looking at returns based on traditional market factors like job growth or infrastructure development. They are now assessing a region's ability to withstand climate change over the long term. This strategy is particularly evident in the actions of large firms like BlackRock, which has recently recalibrated its investment philosophy to account for climate risks. Properties in cities like New York or Los Angeles, once considered prime investment opportunities, are now being scrutinized through the lens of climate vulnerability. Meanwhile, inland cities like Columbus, Ohio, or Madison, Wisconsin, historically under the radar, are becoming attractive due to their relative immunity from rising sea levels, extreme heat, and natural disasters. This growing trend underscores the rise of climate-adjusted assets. Investors are increasingly interested in climate resilience infrastructure, including properties that incorporate flood defenses, fire-resistant materials, and sustainable energy systems. For example, in the Netherlands, where flood risk is a constant concern, developers are designing homes with built-in levees and water management systems to attract buyers seeking long-term safety. At the same time, this shift is creating a disparity between climate-resilient cities and those at risk. As capital flows into safer areas, property values in these regions rise rapidly, pricing out locals and creating new affordability challenges. Meanwhile, regions facing significant climate threats, particularly coastal cities, could see a divestment of capital, exacerbating economic decline. Perhaps one of the most significant, yet subtle changes driven by climate change is the psychological shift in how homebuyers approach real estate. Historically, factors such as proximity to work, schools, or lifestyle amenities were paramount. However, as the realities of climate change become more apparent, climate risk is increasingly a deciding factor for buyers. This shift is especially evident in areas that have recently experienced extreme weather events. After Hurricane Sandy struck New York in 2012, the once highly coveted properties along the waterfront in Lower Manhattan saw a dramatic change in buyer sentiment. People began prioritizing homes on higher ground, away from flood zones, even if that meant sacrificing prime location. A similar trend is unfolding in California, where buyers are avoiding areas at high risk of wildfires, no longer willing to gamble on the environmental stability of their homes. This change in buyer behavior is not merely anecdotal. A 2021 survey by Redfin revealed that nearly 75% of US homebuyers consider climate risk when deciding where to purchase. This shift signals a broader transformation in the housing market, where the traditional location premium, once tied solely to desirable urban areas, is being recalibrated in the context of environmental safety. The emerging psychology of climate risk is not just reshaping local markets. It is fundamentally altering the global real estate landscape. Buyers, developers, and investors alike are re-evaluating their decisions through a new lens, one that accounts for the long-term impacts of climate change. This shift in perception will continue to drive demand patterns, affecting property values in ways that were unimaginable just a few decades ago. Climate change is rapidly becoming one of the most powerful, albeit understated forces in the global real estate market. From climate migration and uninsurable properties to the changing psychology of buyers, the effects are profound and far-reaching. As we move forward, the intersection of climate resilience and real estate will only grow in significance, challenging conventional wisdom about what makes a home valuable and reshaping the very fabric of housing markets worldwide.